Sandip Sabharwal joins us. Let's connect with him to understand that what he makes of the market setup. Sandeep, it appeared like a proper scare on Tuesday. Thankfully, that has not translated into an ugly reality. Do you think the storm has come and gone?
Nikunj, it rarely happens that markets just give a one-day correction and then things are hunky-dory, especially after the fact that when the mid-cap indices have rallied nearly 30-35% from the bottoms in almost a straight line. So I think wishing for a continuous accelerated rise in the markets is not something which would be in the interest of most of the investors, because I think then the fall will also be as drastic, because overall market valuations are no longer cheap as they were in March, April. And there is huge frenzy around small and mid caps. You look at what's happening in the IPO markets. The first 4-5 pages of all pink papers are full of just IPO ads. I think this reflects a build-up of extreme frenzy. I would be cautious on the overall markets for the next 2 months at least.
Right. So Sandeep, in the near term, what should one do then? Do nothing at all and just sit on what you hold? Or do you think ease out from the small and mid-cap exposure, book profits there, and maybe keep that powder dry, or deploy that into large caps, say banks, IT, and maybe pharma?
So in small and mid caps, the strategy cannot be a singular one. So if you have bought something where you don't know why you have bought it just because of momentum, many of these loss-making companies which are moving up every day and with no fundamental basis, and if you have made good money out there, it's best to cash out. If you have some stocks where you think fundamentals are good, it's a good story for the next 2-3 years, you don't want to sell it for a 10-15% fall to buy it again. So I think it's not a singular strategy. It has to be a strategy based on what you hold. Secondly, what's the proportion of these small and mid caps in your overall portfolio? If it's very large, then it makes sense to cut back. And thirdly, what's your overall equity exposure? So if your equity exposure is very minute, then it doesn't matter to you. If it's very large, then it makes sense to have some cash at this stage.
All right, that's the view coming in on the markets, but time to put the spotlight on the editor's take. Today, we're talking about sugar in a very sweet spot, just taking a look at the kind of returns that we've witnessed in the last 1 month itself. It's been nothing short of great, because it's been double-digit gains and a lot of key positives, especially when it comes to global pricing, etc.
We've always looked at sugar that, what's happening to international prices and then what would be the impact of weather patterns here. But this time around, for the sugar space globally and locally, I think the change here is that a lot of food is being diverted for fuel. I'll say it again. Food is getting diverted for fuel. Sugarcane is getting diverted for ethanol. And that, in a sense, is this massive diversion which is happening in sugar. If weather patterns are at play and the food diversion is happening for fuel, which only will increase, and more ethanol blending is going to be increasing. We're talking about 20% now. Then imagine that we are actually looking at sugarcane always been in scarcity. That's the fundamental way in which how things would move. And on top of that, this year in the near term, when I say next 2 or 3 quarters, you pretty much know that international sugar prices are firm. The challenge, Avan, is that for the sugar sector per se, every time sugar prices go up, will the government kick in? Will they do something in terms of bringing the prices down? But the food secretary, I think yesterday, indicated that, look, India is in a comfortable position right now and they do not see there is a reason to get panic. And they are very confident that the new crop which will come in and around Diwali is going to be sufficiently better. So the macro is food for fuel. Second, internationally, there has been a weather disruption which will keep the sugar prices up. Third, government action may not be there after the comments which have come from the food secretary. So all in all, if you blend all these 3 factors up, sugar could be in for a sweet spot. And right now, we've not reached at a level where I can say there's excess sugar, where it may hurt you and it could be a health hazard. So right now, it's that 1 spoon of chini in your coffee, which you really want to, 1 teaspoon in your cup of coffee, which you want to savor. Okay. I think they're there yet.
And that'll sweeten the deal. Okay, there you have it. So Aisha, we're talking about sugar being in an exceedingly sweet spot.
Yes, that it is. But Sandeep, we were discussing this last afternoon too, that, sugar hasn't participated quite much in the entire mid and small cap rally which has taken place. I mean, in comparison to what railway, defense and, the other spaces done, sugar has done really nothing. For new investors, can they still buy into any of the sugar names now?
Among the larger companies, yes, especially the UP-based companies, because they are not going to see a production shortage. In fact, the recent interactions with Balrampur management has indicated to me that in their areas the crop is pretty good, and we could actually see an uptick in production for them, whereas the overall production goes down. I think the UP-based companies are placed well. Among the sugar companies, what we own in some of our portfolios are Balrampur and Triveni Engineering. So Balrampur is the safest bet, I think, because of their strong balance sheet and their overall market presence. And like you were rightly discussing, sugar has been one sector which has not participated so much in the rally. If you look at international sugar prices, yesterday they were trading rupee equivalent of 63 rupees a kg, whereas prices in India, I think for the sugar companies are 39 or 38, 39 still. This is with zero import duty. So even after all the concerns of government interventions, etc. So if those concerns were not there, these prices would have been much higher. I still think that this is one pocket where still we could have some overall return potential vis-a-vis the overall market.
Okay. Sandeep, this entire ethanol play, some are saying it buy it on sugar because food for fuel will be there, sugar cane will be diverted irrespective of what the underlying weather patterns are. What is the best way to bet on this ethanol? Buy sugar, buy Praj, buy OMCs, buy blenders?
I think it has to be the manufacturers of the plants for these. So this entire aspect. So I think Raj Industries is in a sweet spot, and I think the company reinvented itself 2-3 times over the last few years. First with the 1G move, now with the sustainable aviation fuel, the compressed biogas story, as well as the Global Biofuel Alliance. The stock valuations remained lower than many of the other capital good companies because of concerns around what after the entire 20% blending cycle gets over. And now we see new segments of growth. The stock has rallied a lot in the short term, so I don't know what will happen over the next 5-10 days or a month. But I think over the next 2-3 years, the stock will still do very well.
Just wanted to get in, your take yet again, Sandeep, as to what the outlook is when it comes to, the positives within the entire banking space. The fact that we've seen, the fact that it's been strong growth, asset quality has been strong, HDFC, Kotak trading below their 5-year average. How are you looking at some of these large cap stocks now regaining momentum like we have seen in the case of an HDFC Bank, for instance?
Yeah, so among the entire large cap space, if you look at the market overall, it's the large size private sector banks which have been relatively subdued in the near term because they had a substantial rally earlier. And now they've gone through a phase of consolidation. So my preference in order would be ICICI Bank as a core holding, Axis Bank as something where we could see possible potential, still some re-rating, and then followed by something like HDFC Bank and IDFC because it's run up so much. So that's why it falls below that. Kotak still has valuation concerns and management change uncertainty. So that's something we need to watch out for.
All right, in the meantime, there's also the latest note that's come out from Jefferies on the pharma sector, talking about how the core portfolio price erosion could remain benign in the medium term. They are also talking about how the import alert at plants of Sun and Intas may have played a key role in improved pricing, but by and large, they believe that the benign generic pricing due to several factors is hitting the industry simultaneously. Your thoughts, Sandeep, on the overall valuation picture and the news flow that we've seen within the entire pharmaceutical space?
So again, because the markets have run up so much, so we could see some comeback in the defensive sectors, and that could reflect in the performance of some of the companies which have been doing well, like Reddy, Sun Pharma, and the turnaround which we are seeing in Lupin. The news flow is disparate. Some analysts say that pricing pressure still exists. Some companies are indicating it's moderated. But I think overall it's moderated, and the input cost pressures have also moderated. So I think that's plus the fact that rupees depreciated. So I think all of this that is adding to the earnings growth outlook. So in the overall market context today, where markets have rallied to 20,000 plus, I would think that the potential for pharma as a sector to outperform is much greater now.
All right, stay on with us. Let's put the spotlight then on the steel sector that's seeing the impact of the rising raw material prices. But what is leading to this rise in prices in the first place, and what's the outlook on where demand's headed? Let's understand all of that a little bit better with Ashesha, who joins in. Ashesha?
Well, yes, steel stocks are in focus today, and that is because prices of both key raw materials, iron ore and coking coal, have been increasing over the last couple of weeks. In fact, coking coal prices have risen nearly 12% on a month-on-month basis, and now they stand at about $290 per ton. Remember, we rely on imports totally for coking coal, and coking coal is a major raw material. It contributes about 45% of the total raw material cost, and hence any surge in global coking coal prices is a negative for domestic steel mills. Iron ore prices meanwhile have also risen. In fact, Chinese mills have increased capacity utilization, and there is some disruption of iron ore inventory, which is leading to the surge in global iron ore prices. Australian fines rose by about 15% on a month-on-month basis, and NMDC too yesterday announced a price hike of about 300 rupees per ton. Now, if you look at the iron ore prices trend over the last few quarters, this quarter it has been on a lower side, but in the last few days we have seen a sudden surge in both iron ore as well as coking coal prices. Now, as far as domestic steel demand and steel price environment is concerned, that continues to remain solid. Imports from China are coming down, which is a positive for domestic steel demand. Domestic steel prices have also risen by about 11% on a month-on-month basis. So on the domestic front, everything looks good for the steel mills. As far as the current spread structure is concerned, contribution stands at about 38% of the HRC price globally. So current HRC prices stands about $550 per ton, and contribution stands at 38% of the global HRC price. Remember, when recently steel prices rose, all of these steel stocks had run up a whole lot, and now with the surge in raw material prices, let's see how these stocks react.
All right, thanks very much, Ashesha, for those details. Time for some top fundamental stock calls. Let's hear it out from Hemang Jani.
I think a very smart pullback by some of the pharma names, and prominent ones. What we like at this point are Dr. Reddy's and Aurobindo Pharma. Aurobindo in particular is seeing a lot of traction, I think, in the last 3 months or so, both in terms of their operating performance and the stock price performance. Both, it's done exceptionally well. Some of the mid-cap names like Laurus Lab, Granules, they continue to look okay, but one should really look at that as a tactical play, because the entire, the API segment that they are operating in, things are not that clear. But I think as a short term, maybe 3 to 6 months kind of time frame, these two names are looking quite interesting.
The business is humongous. Mr. Vaidyanathan, according to me, is the best banker in India. And I see no let up in this stock. Yes, it's an expensive stock. It has run up far in excess. But who's to blame? There was so much of under ownership. And I think IDFC First is headed higher. As a disclosure for me, IDFC First Bank will be the next SDFC in the making in the next 5 years. So please stay put if you are invested. And if you are looking for corrections, then this would be a good opportunity as it consolidates closer to 85-90. It was a lending institution which had benchmark notes at much higher rate of 9.5%. But almost 80% of that book he has redone, at much lower rates. So yes, there will be this cost of funding. But on the other hand, I think that the growth outlook and the NIMs which they have and the type of variable growth which they are looking at is very, very impressive.
let's continue our conversation with Sandip Sabharwal. Sandeep, wanted your take regarding the QSR space. There's just the news flashing for you at the bottom of the screen where there's a large trade happening on Restaurant Brands Asia as well. But overall, with the World Cup lined up, with a lot of those festivities lined up, do you think it's the right time to buy or it's already past us?
So QSR space has a lot of players. So some of those companies like Westlife, etc., are trading at highs. Some of the others like Jubilant, Foodworks, etc., because of their subdued performance, they are more near 30-40% below. So I think it's not one size fit, but overall, I think there is some positivity because there's an expectation of ebbing of cost pressures and improvement in sales mix as we enter, like you said, the World Cup and then the festival season, etc. And that's what reflected in the performance of some of these companies. Among the QSR companies, we own Devyani as well as Westlife, and I think I would be still positively inclined on them.
Sandeep, in the last month or so, are there any fresh buys that you've made or recommended?
So fresh additions, we added some Praj initially before this run-up happened. Then we've been accumulating Voltas because I think that's one of the larger mid-caps which has not participated in the rally and where I think people are very much focused on the room AC front, whereas on the projects business, their order book has moved up substantially where the execution will come up. And after 3 seasons of poor AC sales, room AC sales, eventually it will also catch up. So I think that's a somewhat contrarian bet. Near-term earning picture is still unclear, but it's something what we have actually been accumulating.
Right. Okay, good to get in those strategies as well. In fact, Kunal, let's check in on the charts of both Praj as well as Voltas while we're at it.
So Praj was one of the first stocks from the sugar-related pack which had managed to break out. Balrampur Chini, I think, had just given a breakout yesterday. Dhampur Sugar, Andhra Sugar, etc. Most of the other stocks have given very recent breakouts, like maybe 1 week back or kind of a time frame on an approximate basis for most of the stocks. But Praj, on the other hand, I think the breakout was seen 1.5 or 2 months back when the stock had broken past about that 400, 450 mark, which had been a huge resistance for the stock price. And now Praj is actually completing a major flag pattern on the monthly and the quarterly charts, and that started off from the 2020 lows when the stock was 2-digit for itself. So it's a very strong breakout for Praj, and it indicates that from where it left off in 2021, and the stock is at 450 after a consolidation of 2 years, the stock is ready, already ready for a breakout on the upside and moving up higher. I would expect the stock to head towards at least 720 to 780 mark, possibly in the next 1 to 1.5 odd year. For Voltas also, this could be interesting because I think Voltas and if I can probably put Havells in the same space, both these stocks have been huge underperformers. Voltas had gone through a price correction, Havells had gone through a time correction. Now Voltas had come back above the 200 moving average just about I think 2 weeks or 3 weeks back when the stock had broken past about 800 levels. So it's starting to show signs of recovery and volumes making a decent comeback. Golden crossover also happening for Voltas on the daily charts. All of that is attractive for the stock and expecting this to be a trending stock going forward.
Okay, so that's the take coming in as far as some of the technical checks on Praj Industries as well as Voltas. But a lot of newsmakers today, and of course quite a few from the IT sector as well. TCS has seen an upgrade coming in from Avendus Spark, and then of course for Infosys there's that $1.5 billion MOU that they have signed with a global client, but it's for a period of around 15 years. Sandeep, right time to buy IT or wait for the earnings?
So I think IT is one sector where I have not been buying so much because of overall growth concerns, both domestic, globally mostly because there's no clear picture on demand revival at this stage. However, what happens is that once the market revives, then the large caps in every sector start participating, and that's something which we have seen in the IT sector also. So I am still not very convinced on the overall IT story at this stage.
Convinced on the IT space, but Nuresh, you are incrementally getting more convinced about the chart patterns there, right?
So one by one, we've seen in IT, it started off with niche small cap and mid cap names going back and hitting new all-time highs, new 52-week highs. And now we are seeing the large caps turning around. So the largest of them, TCS, for example, is back to the prices where it was in Feb, March, where it made a top around 3,500, 3,600. Also in September 21, that is where it went up from 3,500 to 4,000. So TCS is shaping up after a breakout about 35, 3,600 towards that 4,000 mark eventually. HCL Tech is the one which is the most interesting because that stock has been a clear outperformer in the larger names. Broke out about 1,200, now at 1,280, not far away from an all-time high of 1,350. So that could be the next one. And the last one remains Wipro purely because of say a 50 or more than a 40-50% fall from the top. So there is a lot of recovery possible here. So Wipro could go towards 480 to 500 in the short to medium term. So these three names look interesting in the large caps. The mid cap and the small cap IT, we are continuing to see slowly and steadily a pickup. We've seen a LTI Mindtree slowly break out, but the momentum has not been great as it has been in some of the leaders. So overall, we are seeing a selective recovery on the IT pack as such.
The other point to really talk about and note is that Brent prices are back at the $94 per barrel mark. Now, prices, remember, have already escalated to a 10-month high. It's not like we've not seen these 94-odd levels previously in the past. We have. But it is the highest we've seen since November 2022. Remember, Saudi and Russia have extended the production cut, and that's clearly impacting these prices. The cut, of course, is going to get reviewed on a monthly basis. But yes, OMCs, they stand to take a hit on their GRMs. So that's going to get one space which is going to be impacted. The oil explorers, I mean, for them, this is net neutral, a move on crude. ONGC, Oil India, Vedanta, HOEC, they may not see much of an impact really. Higher crude, remember, means higher earnings also for them. For paints, of course, because 40% of their raw material cost is oil and its derivatives, it's going to be a challenge, and we've already seen Asian paints and the rest of the paint sector as well, how it's been a bit of a casualty of late. And that's that's pretty much the case for aviation too. So Interglobe Aviation is one such case in point, wherein the major raw material is ATF or fuel for them. Lubricant manufacturers, again, 50% of their RM cost comes from crude. And then for tires as well, about 40% of their raw material basket does constitute of crude. But Sandip, purely basis the spike up that we've seen in Brent, would you recommend shorting any of these crude sensitives?
So I can't recommend shorting, but I think I would think that there would be real margin pressures come up for some of the sectors. For example, tires was going through a benign raw material price cycle, and now we've seen a 20% move in crude prices. We've seen a very swift 15% move in global rubber prices. So I think such rapid moves in input cost pressures, it's very tough for these companies to pass it to the consumer. So I think we'll see the impact. Similarly for paints, etc., we will see the impact of these. And to that extent, and paints in any case, we are seeing increased competitive intensity due to the entry of grasim. So I think we need to be cautious on these sectors for sure.
All right, Sandip, good to have you on board. Thanks so much for joining in and sharing with us your outlook on the markets.